Welcome to the AB Study Partner. If you're staring down your tax syllabus right now and feeling, well, a little overwhelmed, you have come to the exact right place. Welcome, fellow classmates, to another highly entertaining study explainer. Today, we're focusing on a completely classic, foundational South African tax case that pops up in exams literally all the time. It's the Commissioner for Inland Revenue versus the Witwatersrand Association of Racing Clubs, reported as 23 SATC 380. Get those notepads ready because we're going to break this down so perfectly you'll be quoting it in your sleep. We are getting ready to totally conquer South African tax law together. We're going to take those dry, dusty pages of our legal textbooks and turn them into a show that's actually entertaining for all of us. No more boring lectures, just clear, focused learning that will help us absolutely ace those first-year finals. Okay, let's look at the roadmap that's going to help us dominate this topic. Number 1. The charity race setup. Number 2, SARS enters the chat. Number 3, principal versus agent. And finally, number 4, the beneficial receipt principle. Let's kick things off with Section 1, the charity race setup. To really understand this, picture a very well-intentioned animated cartoon racing club official. His whole goal? To organize a massive horse racing event and do some genuine good for the community. So step 1, this unregistered association of racing clubs organizes a massive race meeting right at the Johannesburg Turf Club. Step 2, they publicly state and promise that all the proceeds, every single rand made from the event, would be divided between 2 nonprofit charities. And step 3, the event was a massive hit. The funds were successfully collected, divided, and handed straight over to those animated charity workers, exactly as they promised. A totally heartwarming South African success story, right? Moving right along to Section 2, SARS enters the chat. Picture an animated SARS official stepping onto the racecourse with a very serious look and a giant calculator. Because where there are rands changing hands, the taxman is absolutely not far behind. Ask yourselves this critical question, classmates. Does SARS actually care about moral obligations? I mean, if you organize a huge event, make a profit, but your entire intention from day one was to give all that money to charity, does the taxman give you a free pass? Well, doing a good deed doesn't necessarily make you immune to tax law in South Africa. The hard truth of the commissioner's argument was this. SARS included the total proceeds of this race in the taxpayer's gross income. Why? Because the taxpayer embarked upon a scheme of profit-making. They organized a commercial event to make money. And here's the absolute kicker for your exams. A moral obligation to distribute funds does not cancel your tax liability. SARS argued that the Racing Association was entirely liable for tax on those proceeds, completely regardless of their noble moral obligation to give that money away. So, how did the court settle this standoff? That brings us to Section 3, principal versus agent. If you're taking notes, star this part, because the entire case hinges on the legal role the Racing Association actually played. It all comes down to a critical distinction. If you're acting as a principal, meaning you're the main player holding the event yourself in your own name, you get taxed. Conversely, acting as an agent means you're merely a representative, stepping in to collect money strictly on behalf of someone else, meaning the principal gets taxed. The court looked at the facts and ruled that the association acted as the principal in holding the race meeting, rather than as an agent for the charities. They ran the show, they generated the profit, therefore, they owe the tax. But the judge didn't just leave it there. They gave us a massive clue on how to structure things differently. Consider the alternative. What if the charities were the principals? If the 2 nonprofit charities had actually officially hosted the race meeting themselves, and the Racing Association merely acted as their helpful agent, then the charities themselves would have been the ones taxed. And, because they're charities, they likely would have enjoyed tax exemptions. But because the association took the lead as the principal, the tax burden fell squarely on them. Section 4, the beneficiary receipt principle. Grab your highlighters, first years. This is the absolute golden doctrine you need to memorize for the test. The rule of beneficial receipt means that once an amount has been beneficially received by or accrued to a taxpayer, they are taxed on such amount even if they have an obligation to pay it over to someone else. The crucial point here is that getting the money in your hands as a principal means you pay the tax, even if you're just passing those rands along to a charity right afterward. You beneficially received it first, so it hits your gross income first. To sum it all up perfectly, in tax law, your legal capacity dictates your liability, not your charitable intentions. The strict principal-agent relationship under South African law completely overrules the heartwarming story of giving money to charity.
If you're the principal who embarks on a profit-making scheme, you welcome SARS into the chat and you pay the tax on the income you receive. It's an objective test of your legal capacity, not a subjective test of your good heart.
And there you have it, classmates. You have just mastered CIRV Witwatersrand Association of Racing Clubs. Remember the cartoon racing official, the serious SARS auditor, and the golden rule of beneficial receipt, and you will absolutely crush this topic in your exams. But it leaves us with a lingering question. If tax law strictly ignores our good intentions, how does that impact the way charities operate and fundraise in South Africa today? Good luck with your studies, keep reviewing your case law, and please subscribe.